Welcome to our Macro and Market Intelligence Report, focusing on India's FMCG sector. Today we delve into the economics of habit, how one product built an empire. This video provides a snapshot of India's macro landscape, market strategy, and a deep dive into a dominant brand's analysis. The table of contents covers India's macro snapshot, RBI policy, inflation and input costs, global macro headwinds, and FIIDII flows. We will also examine the FMCG market structure, sector breadth, a dominant brand's technical and fundamental view, and trading strategies, concluding with risk factors and disclaimers. India's policy environment shows a stable repo rate at 6.50% after 7 consecutive pauses, suggesting a spending tailwind for consumers. Strong rural credit growth at 14.2% signals recovery, driven by improved agricultural income. Urban premiumization remains intact with all-time high credit card spends on premium products. A future rate cut would further stimulate the FMCG market. CPI inflation shows a cooling trend, providing input cost relief, such as lower palm oil prices and stable crude. This cooling trend means fewer price increases, allowing brands to focus on volume growth and penetration. This aligns with a gross margin expansion cycle, as cost tailwinds combine with premiumization to improve margins by 150 to 250 basis points in the next fiscal year. The anticipated easing of the U.S. Fed funds rate cycle suggests a potential weakening of the DXY, which could strengthen the INR and reduce import cost pressure for the FMCG sector. Domestic institutional investors continue to provide structural support, offsetting foreign institutional investor outflows. While a U.S. recession poses short-term sentiment risks, DII flows and commodity cost reduction offer a net positive outlook for Indian consumer goods. The Nifty FMCG has outperformed the Nifty 50 year-to-date. Subsector performance shows strong growth in personal care and grooming, OTC healthcare, and e-commerce. Urban and rural volume growth remains robust. Overall, the consumption indicators are healthy, with FMCG penetration at 63% and modern trade accelerating, reinforcing the sector's defensive appeal. This dominant consumer brand shows resilience, trading at a premium PE of 51.4x and a market cap of 2.22 lakh crore. Technically, the stock is building momentum after a correction, with a positive MACD and rising OBV, indicating institutional accumulation. Key support levels suggest a buy zone around the 200-day moving average, while resistance targets the 52-week high. We outlined 3 scenarios for the consumer brand: a bullish case with a 40% probability, targeting 7,380, a base case with a 42% probability, expecting a range of 6,400 to 7,100, and a bear case with an 18% probability, falling towards 5,950. Strategy dictates a bull call spread for the bullish scenario, and a covered call for the base case to profit from premium selling in a low beta environment. Risk management rules emphasize position sizing to a maximum of 2% portfolio capital per trade. The stop-loss protocol dictates exiting positions if the stock closes below 6,400. Profit booking suggests locking in 60 to 70% of maximum profit before expiry. We also highlight the importance of monitoring VIX and currency movements for their impact on imported raw material costs. Key risk factors include input cost reversal, a volume growth slowdown, competitive intensity, INR depreciation risk, and valuation risk. Official data sources used include the RBI, MOSPI, NSE, SEBI, FRED, and U.S. Treasury. Please note this report is for internal analytical and educational use only and is not investment advice.